I'm joined today by Aakash Thombre, Managing Director at Goldman Sachs Asset Management. Aakash is among the incredible investors sharing insights at the Fixed Income and Alternative Credit Investment Forum today. Welcome, Aakash. It's great to have you with us.
Thank you. It's great to be here.
Does identifying the macro regime matter for the multi-asset credit investor?
Yes, the macro regime is critical for identifying the opportunity set and an environment, the investing climate under which companies are operating in. It yields a lot of specific insights about corporate behavior. Those insights include, are companies confident? Are they expanding into a growing market? Are companies facing elevated borrowing costs, potentially factoring that into their ideal capital structure? These decisions are critical in terms of assessing the forward-looking opportunity set that companies are operating in. And while it's difficult, if not impossible, to predict the future macro environment, it is possible to test the current macroeconomic climate, which tells a lot about corporate behavior and the investment cycle moving forward.
How should an investor think about seeking returns without stretching for yield and compromising credit standards in an environment where spreads are tight?
The first and most important thing is underwriting discipline. Companies need to be underwritten for credit strengths, and at the end of the day, carry or additional yield can be eroded quickly if there are defaults or permanent impairment of principal in the portfolio. That's why we believe the depth of sector research and company research staffed by individuals who understand management teams, capital structures, the competitive environment that companies are operating in are just critical. A second approach that can be used to defend against an environment where spreads are tight and there's a temptation to stretch for yield is diversification. Diversification offers tremendous benefits through a focused effort to uncover as many opportunities as possible. One will inevitably find enough opportunities to put into a portfolio that meet both the underwriting discipline standards as well as the diversification principles, which can achieve the majority of yield and return objectives for clients.
Where might AI have the biggest impact for global multi-asset credit investors?
I think it's a great question. We're several $100 billion into what's projected to be a $3 to $4 trillion capital investment program in just the US in data centers onshore. And I think that that is clearly going to have benefits and changes to the operating environment for a number of things that we take for granted every day in ways that we can't even imagine. And I think that that is going to be very exciting for our future. In the immediate term, as investors in the multi-sector and multi-asset credit space, we're utilizing AI for two main effects. The first is to really evaluate more opportunities quicker. That first look, that first screen, is a company interesting, and utilizing the broad array of knowledge embedded within the AI services to help us identify and pinpoint those key risks. And the second way we use it is really as a way of unpacking complex business models in a more efficient manner. Whereas historically, there may have been very complex business models with multiple subsidiaries doing multiple things. We can use AI as a tool to now go even deeper and evaluate all of those subsegments with some greater efficiency than in the past. Ultimately, this technology is here. It's going to evolve. We use it as a tool to augment our credit research, and it allows us to spend just that incremental hour on higher value, more important ways of developing investment views on ideas. And that may include just spending that extra hour with a management team or flying out to visit a company or engaging with an industry expert. And these are all things that ultimately drive alpha and opportunities for our clients.
Should an investor pay for downside protection, i.e. a tail risk hedge?
I think that's a critical question. And the benefit of diversification in a portfolio extends also to downside environments or shock environments that are unpredicted or unpredictable and not predicted by current securities market pricing on a today basis. And so by the time you enter those environments, it's actually too late to consider paying for that protection upfront. There are really two ways to consider paying for that protection, and those environments where liquidity demands and forced selling result in market participants selling assets at prices that discount more than their fundamentals warrant, which represents a major opportunity. And so investors need to consider the fact that these environments tend to offer some of the richest prospective returns, and how can they be prepared for those environments before they occur. There's really two ways to do this. One is by considering liquidity sources within your existing portfolio and preparing through that measure. And the second is through tail risk hedging, as you mentioned, which also provides an interesting way of both preserving the return profile when environments are strong, but preparing for potential environments where it may be weaker. And that insurance policy, if you will, can just provide investors the ability to play offense when those inevitable shock environments materialize. At Goldman Sachs, risk management is in our DNA. We prefer to prepare for these types of environments rather than predict them. And I think all investors should consider that as an important part of their portfolios.
What are some of the main vulnerabilities global credit investors may be exposed to, and what should they do about them?
Yeah, the backdrop today looks actually relatively normal after years of being abnormal. We went from an environment where macroeconomic indicators were severely imbalanced to a regime where macroeconomic indicators look more akin to a normal business cycle. And I think that's an important change in the prospective risk landscape that is different than the last 5 years, but is probably more akin to the prior decade, where what you had was generally a stable set of macro risks and a more elevated competition and competitive environment at the sector level. So you have these rolling sector risks through the economy as businesses compete. And I think the rise of AI will certainly create winners and losers. The competitive dynamics across a wide variety of industries continues to evolve. There's new technology creating winners and losers. And what I anticipate that investors should be prepared for, and I'm actually quite excited by that opportunity set, is the ability to capitalize on the dislocations that occur through these rolling sector dynamics.
Thank you so much, Aakash. We're going to need to leave it there and get back to the forum. I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Fixed Income and Alternative Credit Investment Forum.
Terrific. Thank you for having me.